Welcome to Stocks in Translation, your essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. And today I'm joined as always by Sydney Freed, our intrepid producer, along with Callie Cox, who is now, the Chief Market Strategist over at Ritholtz Wealth Management, a brand new role for you, and really excited that you're here.
Hi, Jared. It's so great to be here. And you know what? I feel like I'm in a familiar role because I've just been a fan of Ritholtz and Yahoo Finance for years.
All right, appreciate it. And we're going to be joined here. Actually, we're going to talk about today, this is the psychology of money. We're going to kind of frame the direction of the show and some of the topics around that. And our related phrase of the day is bias. We've all got biases. Sometimes they help us, many times not. But we're going to dig into that and see what it means for investors and investing. And this episode is brought to you by the number 6,000. That is the new street high target for the S&P 500 by Evercore ISI. We always take a note when a big bear throws in the towel. Now, Callie, Sid, I want to break down where we are in the markets, and you can pick up the ball here, but we've got the NASDAQ and the S&P 500 at record highs. The Dow has been lagging. By the way, I was just looking at the month-long tallies in June. The Dow is negative by a small percent. The NASDAQ 100 is up 7%. So, you know, we keep hearing these markets, these concentration arguments. What are we to believe here?
Well, first of all, I'm going to say I don't have a crystal ball. Every strategist who comes on this show should say that. But yes. I'll tell you everything that I'm seeing, and I'll teach you about, how all these dynamics work together. So yes, we're at record highs. The S&P has been pretty much going up since October of 2022. So we're almost 20 months into a bull market.
Getting long in the tooth?
You know what? The average bull market since 1950 is 5.4 years long.
So no.
So based on history, maybe not. And I think it depends on the job market, but I'm sure we'll get to that. You asked about tech.
Yes.
Yes, the gains are very concentrated. You hear a lot about NVIDIA, Apple, Microsoft. Well, the market's rewarding that. You're seeing a lot of the gains happen in those stocks. And unfortunately, that means that, most of the stocks, most of the brands that we work with every day aren't participating fully in the bull market.
Yes.
I think that's a good thing. I think that means more potential. I think that's a good reason to look outside of tech. But you know what? If you were an investor in the late 1990s, this probably freaks you out a little bit. This is
a lot of echoes of what happened back then. We had a dot-com bubble. It was busted. But so for all the arguments about concentration, I'm just wondering, how do they stack up? Is it really such a bad thing that we have just a few stocks contributing to the rally?
Well, it's natural, first of all. A lot of money. More
common than you would think?
More common than you would think if you look at history. And I'm a historical nerd. I love historical data. You probably know that if you follow me on Twitter.
I join you in these efforts sometimes.
Yes, of course. We're all nerds here, let's be honest. But market concentration is natural. And what I mean by that is when markets go up, usually the stocks that are doing really well get more money because people hear about it. They want to invest. In this age of ETFs and market cap weighted indexes, some of that happens just because a lot of us put our money into an index ETF, and that money goes, almost directly by market cap into these stocks. So it happens, right?
So winning begets winning, like the winners get bigger.
The winners get bigger, exactly, Jared. But this is extreme.
So there is a historical
valid.
aberration here a little bit.
Exactly, yeah. And there's this crazy stat, like 70% of S&P stocks have underperformed the index both last year and this year to date, which is a lot of stocks that are not keeping up. So it is a little worrying, and it's probably a good reason if you're in the NVIDIAs and Apples of the world to consider, what's happening here and to think about, maybe spreading it out a little bit.
Yeah. So Callie, if you are an early investor, if you know nothing, but you're hearing about NVIDIA and all the Mag 7 stocks, what's just your general advice for them? Do you get in on those stocks? Do you go to stocks that have maybe been one of the underperformers in the S&P in the hopes that you're kind of diversifying?
Chasing laggards. Some people do that.
Oh, chasing laggards. I do it every day.
It's a new show.
Yeah. So what do you do if you're early on?
Yeah, that's a great question. And I'll emphasize here that everybody is different, right? We're all investing for different goals, different reasons. So the way you invest is going to look a lot differently than the way I invest. And I'll say it too, you know what? If you hear about a stock from a friend and you say, that brand's interesting, I know a lot about that brand, that's a perfectly legitimate way to invest. A lot of people, invest based on the brands they like. And typically it works because if a lot of people like a brand, chances are they're making a lot of revenue and hopefully they're managing their costs on the other end. And, it could be a good investment. But if you're an investor, first of all, you need to sit down and have an honesty hour. You need to understand how long, most importantly, you have to invest this money and what kind of risk you can stomach. Can you stomach losing half of your money in the span of a month? I mean, maybe not, that's tough, but that's something you can go through if you invest in a single stock. And you know what, if you're a tech investor, just realize that there is a huge market outside of tech. Tech has a lot going for it right now. I think it could have more in the tank, especially if, we do see lower rates and a progression of this AI story. But at the same time, do you want to be picking winners here? Typically winners
As long as they
are
win.
winners
Well, as long as
for
they
life.
win.
Yeah, winners if they win, right?
If they win. So kind of going off of this, what's your one piece of advice for those same investors to do their due diligence? And even if they're hearing something from friends or family or they're seeing stuff online, what's like the one thing they should always
And don't say
check?
read the prospectus,
Yeah.
although maybe you should.
Read the prospectus. I'm kidding.
Read the whole prospectus.
Well, it's not bad advice, but
No, it's not.
I'll go back to finding your why. Sit down and really understand, have an honesty hour with yourself on why you're investing. A lot of investors out there,
A lot of it's for ego and for reasons that aren't going to get you kind of safety for your money or returns. So
exactly, and look, I'm not going to poo-poo how anybody invests their money, right? It's their money, they can do whatever they want. But a lot of people are investing because they want that nice nest egg, because they want to, have a nice retirement, because they want to have a beach house down the road. And look, if that's you, there are a lot of ways to invest where you don't have to extend yourself and try to hit that home run. If you want to do that, that's great. And if you find, stock picking to be interesting, then do it. Just do it on the side and understand what your goals are.
great advice. Go slowly. I think this would be a great time to introduce our word of the day, which is bias. And this really relates to the psychology of money and why we're doing this in the first place, which is investing. So here's the definition of bias I was able to cobble together from a few different sources, including psychological sources like Psychology Today and also some financial sources. But bias refers to a tendency, inclination, or prejudice toward or against something or someone. So a tendency, inclination, or prejudice. In the context of money and finance, bias can significantly influence the decision-making process, and it potentially leads to irrational or suboptimal outcomes. So I have a few different types of biases, and this goes beyond investing, but home bias is one where we favor what's really familiar to us. The grass is greener bias. We like that shiny new object over there. Overconfidence bias, kind of self-explanatory, but quite dangerous to think you know something if you don't really know it. And then recency bias, I think that's a really common one. We tend to be influenced more to a greater degree by what just happened. And that kind of fits in with a lot of investing mantras like you're always fighting your first bear market, because that was the one that kind of cemented itself in your head. So Callie, my question to you, what do you think of bias and how would you tell investors how to approach it?
Bias is everything, because let me tell you, your brain influences how you invest more than you think. And the wild thing is, your brain probably isn't wired for, I know it's not wired for investing.
Yes.
Because your brain tells you to run away from risk. And as an investor, broadly, it generally pays off if you're a long-term investor to lean in when everything feels scary. Of course, there are a lot of asterisks you can put there, but one thing you have to conquer as an investor is your brain and these biases that work through you your whole life about money. Jared, I could talk about this for hours, but psychology is so interesting when it comes to how you view money.
So Callie, how can investors kind of stack the deck and make sure they're as prepared as possible to deal with some of these market biases?
That's a great question, and I think the answer is very dynamic. But, in general, realize that these biases are a thing. I mean, Jared, you read off 5 very good biases to study, and, take them, understand them, and look at your own portfolio in the view of, maybe the opposite way. So, like if you have home bias, for example, look at your portfolio and say, what if I believed international stocks are going to just absolutely kill it this year? Am I ready? Because that is a scenario that could come across. It hasn't happened a lot lately, but you need to be prepared for that. And at the very least, that helps you challenge yourself, right? It helps you say, you know what, I think this way, but let me step out of my skin for a little bit and understand where my weaknesses are.
number one investor mistake that I've seen over the years, and I've done it plenty of times myself, and that is just kind of locking down, doubling down on what you think you know, when in fact you should be paying attention to something over here, changing your opinions, but you get locked in this mindset like you know what's going to happen, and you don't see what's going on, and you miss warning signs. There's always warning signs, but we just seem to miss them, and it's not a mystery how. You spoke, you had some really interesting words here, and it gets back to fear and greed. And the human brain is not wired to invest. I mean, it's not just fear, it's greed. We should be doing the opposite of what our brains are telling us a lot of the percentage of time in trading, and that's why it simply doesn't work out for a lot of people. Now, what do you do to overcome that? I think you just laid out some great habits, and that's what it's all about, is just trying to get up our habits, going in the right direction so that we have a chance of landing on the right side of the market. But if you're defending this one position on Twitter, formerly Twitter, on X for 3 months and it's gone the other direction, well, that's an obvious example, but that happens a lot.
I love that you just said we're not wired to invest, or your brains aren't. Like, that's
It's
so
true.
interesting. Yeah.
Let me give you an example. So, okay, we all know not to touch a hot stove, right?
Oh, but you want to touch it.
And as a kid, you touch it that one time and then you say, oop, never again. Well, that's a perfect way to think about investing, because the reason why we don't touch hot stoves, or after the first time we touch it, we don't do it again, is because our brain says, no, don't do it. That's going to hurt. That's going to cause damage to your fingers. And that's what your brain is supposed to do. That's why it's your brain. That's why we are sitting here. Like, it's a survival tactic.
Yeah.
But it just doesn't work when it comes to investing in markets and thinking long term, which is so wild. And I think that's why there are so many arguments and thoughts about how to look at money, because it is so unnatural.
And it can be so frustrating. We've all seen a lot of famous people melt down on X while they have lost a lot of money. I'm not going to mention any names here. I do need to take a short break, but coming up, we're going to be talking about market concentration even more, and how Taylor Swift is influencing monetary policy over at the Bank of England. All right, we are back here, and it is time now to get to our sponsor. This episode brought to you by the number 6,000. That is a new street high target by Evercore ISI. That's an investment bank on Wall Street. And here's a quote from Julian Emanuel, who wrote the note. The pandemic changed everything. Record stimulus, elevated household cash balances, and low leverage support the consumer. Then came AI. Today, Gen AI's productivity potential in every job and sector is inflecting. The backdrop of slowing inflation, a Fed intent on cutting interest rates, steady growth have supported Goldilocks. So I think the story for me here isn't the nitty-gritty details. It's that they went from 4,750 in the S&P 500 to 6,000. They are the most bullish on Wall Street. They kind of threw in the towel here. So when you hear something like this, and I don't expect you to comment on your colleague or there are specific bullet points here, but what do you think about that?
Well, that's happening a lot these days. We see headlines like that all the time. And I don't want to name firms, but there's one reason why we don't do S&P 500 targets, because we believe that every investor just needs to stay in it for the long run. Like I said, we all have our own goals, and you don't need somebody, standing out there pretending like they know what happens next. I understand why strategists do it. We don't do it. That's our philosophy. But it makes sense, right? The S&P has surprised everybody this year.
And most years.
And most years. That's true, Jared. It's true. That's just the way it goes. But this year, we've had a lot of weird cross tensions to consider. And the biggest one is interest rates, right? Interest rates are sitting at 5% right now. And when interest rates are high, behaviorally, it makes sense to put more money into cash. You're taking less risk and you're getting high rates on it. Why wouldn't you do that? But while all this is happening, stocks keep moving higher. And as we said earlier, it's very concentrated in tech stocks, which makes a lot of people nervous. When I think about the stock market, I've been a little more bullish, a little more excited than the average strategist, because I believe so much in what we're seeing in the job market. We are seeing a solid but slowing job market.
Personal story, too.
Personal story. Look who started a new job. Jolts. Job openings right there. I don't think that's the correct term, actually.
Close enough.
Yeah, close enough. But the job market is so strong, especially for people like you and me, the millennials. And wage gains are quite high as well. Wages have been outpacing inflation for the past 14 months. That is a great thing to think about if you consider that people spend money when they have income. A lot of people's primary incomes come from their jobs, and consumer spending is 70% of the US economy. Look at corporate profits. You see the same thing. Corporate profits dipped a little bit in 2022 coming into last year, but they're rising again, and there's a lot to be excited about here. So I think that there are some doubters, and I understand feeling that way, feeling nervous about it, but I think
Once again, feelings sometimes betray you.
Yeah, it's true.
Yeah, I think we are seeing some of this bullish excitement from analysts. We've seen a couple of raises of S&P targets. I want to back up though and even ask, I understand your firm doesn't do this price target. How do analysts even come up with an S&P price target?
It is a good question, and there are two main ways to do it: top down, bottom up. Top down is considering where the economy is, zooming out and taking the 10,000-foot view, and then digging in and understanding GDP rates, understanding inflation, understanding
interest rates,
the broader trend of corporate profits. Interest rates, that's another good one. And then coming up with a target based on that. A lot of times you see people say, I think S&P 500 companies are going to make X amount of money per share this year. And if you multiply it by this valuation, considering where inflation is, how excited we think investors are about the markets and all these different variables, this is what we think the target will be. I think they're a bit misleading when it comes to everyday investors, though. They're more of like an institutional marketing tactic. That doesn't mean you can look at them and, overanalyze them, but I caution you against putting too much weight into them.
Well, I was going to say, I see this so much in data or in analyst predictions. Like, you fall behind, the S&P goes up, your target was 200 less, now you're raising it 1,000.
Seems like a game, like a big circle.
But you just keep raising it as it goes up, and it's kind of, I don't want to say it's like useless.
Arbitrary,
it's arbitrary. Like you see similar things with people trying to predict where interest rates are going. You predict what the jobs numbers are going to be. Why is this everything to do with the stock market? We're predicting so much. How does a simple investor kind of cut through all those predictions and make their own choices?
Passive. I mean, that's a great one. You can avoid the great.
You understand that nobody has a crystal ball and that we're all students of the markets here. I will never claim to know what happens next. Nobody knows. I think that there's a Warren Buffett quote out there about how he calls himself a student of the markets. If Warren Buffett doesn't know what's coming next, let's be honest, why are we playing?
Somebody would call him and he doesn't know, so there you go.
Yes, but he's smart in admitting he doesn't know.
Yeah,
very smart.
Voracious reader, so nothing to take away from his connections there. I do want to get to a taste of Hollywood here. It is okay, here we go, because who better to grace the Who Wore It Better playbook than the one and only Taylor Swift? So we're going to get to this. In Liverpool, England, Sunday night, she notched her 100th show of the Eras Tour. She is expected to add £1 billion or more in spending when all is tallied over there. But all that spending comes at a price, inflation. And here's where Wall Street comes into play. We have TD Ameritrade. They're out with a note Friday saying that Taylor's tour could add 30 basis points or 0.3% to services inflation in August, and about half that in headline inflation. Again, that's in the UK. So Taylor's 5 concert dates in jolly old England in the middle of August, because she's going back there, they are expected to boost prices such that it could alter the Bank of England's plan to cut interest rates, says TD, says the analyst. Meanwhile, we know how this story played out in the US. Swift got shout-outs by the Federal Reserve in official press conferences and business briefs. Investment bank Nomura estimates that monthly travel inflation, it rose 2.1 percentage points for US cities in the Eras Tour. One more piece of evidence. Look at the box office, because you got her movie, Taylor Swift, The Eras Tour. This is based on her final US concert. It has already pulled in $250 million, and that's just an incredible run. So I got to ask you, considering all of this, which country is wearing the Taylor Swift inflation, tour hype better?
Wow, that is such a good question. And full disclosure, I'm a Swiftie, so I love that you asked me this.
Yes.
So first of all, TD's note about Taylor Swift delaying interest rate cuts is a little extreme, and I'll tell you why. So a lot of the inflation that we're seeing in the UK and Europe has been goods-based. Not to say that there hasn't been this services, this persistent inflation going on underneath, but the big problem that we've seen has been, food prices. It's been gas.
Which is different than the US.
Exactly. The US has suffered from that, of course. I mean,
Yeah.
we've all paid at the pump, right? But in the US, the big problem has been services inflation, what you pay for a haircut, what you pay for insurance, what you're paying for traveling, airline tickets, concert tickets, all of that. And that's influenced by demand. Europe has a little bit of that, but their problem has largely been a supply issue. They were especially exposed to, and still are exposed to, the challenges we see in Ukraine. They're exposed to, different trade, I call them trade dynamics across the globe. And, they're also at a point where their economy is sputtering out a little bit. So for somebody to say that, Taylor Swift's, few day visit to a European country could influence a central bank, I'm probably calling BS on that because
Big call.
It's not the right issue, right? But at the same time, that is kind of what they want to see, right? If their economy is, falling off a cliff is extreme, but if their economy is slowing, they want to see consumers get excited and spend money in their cities.
Callie, I love how you were able to break that down, number one. I do need an answer from you, though. So is it the US or the UK that is wearing the Taylor Swift hype train, I guess, to a more extreme?
The UK needs it more right now. I think the US also needed it last year, but the economy was stronger than people expected. And I'll say one more thing. So 70% of the US economy is consumer spending. European countries are less exposed to the consumer. I wish I had a number for you, but they don't get that benefit as much as we do.
So goods matter more.
Yes, exactly. Goods and businesses, for that matter.
Why is that? Why is the consumer spending more a part of the U.S. or
And not
makes up more of a
services? They
bigger
don't have the
chunk?
discretionary income, or?
Well, look around you. We're Americans. We're very good at spending money. I think
see a
that's the
green
main
screen.
reason.
On services more than goods.
but
That's true. We are very
love
good.
spending money.
We are very good at spending money. We are going to throw up a little disclosure that you're a Taylor Swiftie. We must. My question for you is personal. We talked a little bit in the break about how you actually saw Taylor Swift.
I did.
Saw her in Madrid.
Yep, I did.
How was that?
Sweet.
I don't want to go into anecdata. Oh God, I'll leave the economic
We
commentary
need to be
there,
worried
but-
about Spanish inflation. Exactly.
How much did
don't
you
think so.
contribute to the economy?
Personally, more than you wanted.
More than I wanted, but let me tell you, it was an incredible show. The production was just fantastic. Taylor is just such a good singer. I have nothing but good things to say. There's a reason why you keep hearing all these rave reviews about it. I was on the floor. I stood for 7 hours. My feet were killing me at the end, but totally worth it. Economy-wise, so economic commentary, because I always got to bring that back in. The show was sold out, first of all, but you saw a lot of Americans there saying, I couldn't get a ticket in the U.S. This was my chance.
Yes.
And in fact, I was in Portugal as part of that trip too, and I was talking to a gelato stand cashier, and he was like, people in Portugal are actually quite mad because they were almost crowded out by the Americans who didn't want to pay $2,000 for nosebleed seats in the US. So I think that's a really interesting dynamic. I don't want to extrapolate too much because that's anecdata, but it really goes to show how well the US is doing compared to everybody else. And that's an important thing to remember right now as we think about rate cuts in the US versus rate cuts in Europe.
That it's relative.
It's all relative.
We got 20 seconds for investors. One last piece of advice, or just throw something out there into the ether.
Think long term.
Yeah.
I don't know if you caught Roger Federer's commencement speech, but he talked about how he only won 54% of points, but he won 80% of his matches. The stock market works the exact same way, and my colleague Ben Carlson wrote about it today. It's all about those little moves compounding over time. And just remember, we're all learning here.
Yes, we are. And on that note, we're going to keep you tuned to Yahoo Finance, where you can learn much more, but keep that dial here. Thank you for watching Stocks in Translation.